As revealed in the minutes published yesterday, Fed Reserve policymakers were very cautious about further rate cuts at their meeting on November 7, and this caution stance is justified. The Fed made its decision just 2 days after the presidential election and had to account for all possible scenarios. However, another statement from Donald Trump may cross out forecast by most seasoned experts. While the economy, unlike the market, operates under different rules and is currently little affected by the short-term ideas of the incoming US president, Trump's future decisions will eventually impact it as well. For example, raising tariffs on Canada, Mexico, and China will likely entail similar retaliatory measures from those countries. Canada has already warned that in response to new tariffs, it will also raise the prices of oil it sells to the United States. It means gasoline refined from imported crude will become more expensive for consumers, as will other imported goods. Considering that the Republicans won this year's election largely due to the dissatisfaction among Americans with the high prices, the arithmetic does not exactly work in their favor. Donald Trump's threats may be merely a tactic of maximum pressure. However, such eccentricity from the US president increases market uncertainty, which serves as yet another argument in favor of a stronger US dollar, although the US dollar index consolidated around 106.5 today. And this was a temporary retreat in anticipation of a new economic reports. For more details on economic data releases and the impact on the currency market, check out our Traders Calendar. Speaking of influence, the fact that Trump did not mention Europe in his latest tariff speech does not matter a lot to the EU. After all, he has addressed this issue before, so the US will hardly overlook its European partner allies. Are they no longer allies? In any case, market sentiment in the Eurozone is far from optimistic. Moreover, the European Union economies are under pressure not only from the potential US trade measures, but also from a weak domestic growth. Particular concerns revolve around Germany, which is currently going through a deep industrial crisis. Over the past decade, the manufacturing sector has contracted by approximately 5%. The main cases of the crisis include high energy costs, a shortage of labor, and growing tensions between the EU and China. If US tariffs are added to the mix, the situation will only worsen. Judging by the current economic conditions, recovery is not on the horizon. German consumers are already feeling the impact. For example, the Consumer Sentiment Index published today in Germany dropped to minus 23.3 points, the lowest level since May this year. Interestingly, the euro rebounded in response to his latest tariff announcement yesterday, likely because Europe was not mentioned in it. Besides, the single currency may gain some support in the near future due to portfolio revision by investors at the end of the year. As a result, more euro buyers might enter the market, and today, despite tough fundamental conditions, the euro-dollar pair gained momentum, albeit slowly. Yesterday, the bulls even tried to push the euro-dollar pair up. So, the instrument consolidated above the key trend resistance of 1.0470, and this attempt may be repeated today. If the technical resistance area of 1.0470 to 1.0484 is breached, traders might consider long positions with a target at 1.0608. Conversely, if a bearish scenario unfolds, the bears may target technical levels of 1.0408 and further down. to 1.0332. However, most traders prefer to avoid robust trading activity after 16:30 until crucial US inflation and GDP data are released. Oil prices are reacting mainly to news from the Middle East. The prices started to decline shortly after the first rumors of a possible ceasefire in the region. However, investors still consider this scenario that these rumors might not come true, and this uncertainty caused a gradual rise in oil prices, with the Brent testing the upper border of the intraday range of $72.10 to $73.30 per barrel. As soon as it was confirmed that Israel and Lebanon had signed a ceasefire agreement, oil prices immediately turned downward. Currently, the Brent crude is trading at about $73 per barrel. However, the key target remains $71 per barrel. And considering that the news broke yesterday evening, the downtrend is likely to remain relevant today as well. And after reports of a ceasefire in the Middle East and the following drop in oil prices, the Russian ruble took a nosedive. However, the ruble soon bounced back to the levels it held before the news of a temporary truce between Israel and Lebanon was announced. So the main reason for the ruble's weakness is that it's strongly oversold, as it has been steadily losing ground over the past 2 weeks. While the market is ripe for a correction, no proper catalyst has appeared yet. On the contrary, the ruble weakened further to 110 per dollar, in line with the decline of other Russian assets. So, additionally, the mandatory currency conversion requirements for major exporting companies have been lowered to 25%. For comparison, at the start of the year, this threshold was set at 80%. And as a result, the demand for the rubles in this sector has fallen by more than 3 times. So that's all for today. We continue to follow developments in the financial markets. Subscribe to our channel and see you soon.